Well, good morning and welcome. My name is Teresa Campbell, and you have joined today's PIM and PIA Mid-America Financial Executives Council. Our presentation today is on economic outlook from the Federal Reserve Bank, and Alison Felix will present a short presentation. She has another meeting right after this, so she'll leave us, but we're going to stay on and open the discussion where we'll ask you guys to unmute and give comments about this program as well as future programs that you're interested in seeing from the peer group. Now, note that all of you initially are placed in mute mode so we can get a quality recording, but we encourage you to add comments and ask questions during the program by typing them in the Q&A field at the bottom of your screen, and we'll try and ask them at the most opportune time. The Financial Executives Council is coordinated by leaders in both the North Central and South Central regions of the U.S. They guide the programs and content offered 6 times a year, so every other month. And the focus is on financial reporting and compliance, data management and security, and financial policies and planning. Our council co-chairs are Carl Nathy with Myers Printing, Ryan Wagner with Action Mailing and Printing, Matt Wills with LB Carlson, and Ken Rain with Wallace Carlson Printing. Ken, will you introduce our speaker?
I'd love to. I get the proud honor of introducing Alison Felix. She is a senior policy advisor at the Federal Reserve Bank in Kansas City. She is responsible for briefing the Kansas City Fed's president, who is a member of the Open Market Committee, on economic and business activity in the 10th District. She serves as editor-in-chief for several of the bank's publications, including the Economic Review, Economic Bulletin, and Charting the Economy. In addition, Alison conducts research on issues related to public finance, labor dynamics, and regional growth trends. Alison joined the Federal Reserve in 2007 as an economist, and she has been promoted throughout. In 2012, she was promoted to the Denver branch executive, and she holds PhDs and MAs in economics from the University of Michigan and a BA in math and economics from Kansas State University. She currently serves on the advisory council for K-State's Department of Economics and the Dean's Business Advisory Council for the K-State Business School. She also serves on the Colorado Governor's Revenue Estimating Advisory Committee and participates at Metropolitan State University's Community Cabinet. After that long introduction, Alison, have at it. Thank you.
Oh, thank you very much, and thanks for the kind introduction. Probably could have shortened that of it on my end, but happy to be here this morning, and thanks to everyone who is joining to hear a little bit more about what I see happening in the national economy. So hopefully you can see the slide deck. And of course, now that I say that, it's not advancing. Oh, there we go. Okay, so starting with the overall kind of outlook themes. As I'm sure you're all aware, we have quite a bit of uncertainty in the economy, but overall growth in the US economy remains solid. Inflation has eased considerably over the past few years, but remains above the Federal Open Market Committee's 2% target. On the labor market side, we see quite a bit of cooling over the past year, but broader measures of labor market activity suggest some stabilization. So given the still elevated inflation and signs of a stabilizing labor market, the FOMC has held rates steady this year after lowering rates by 75 basis points in 2025. So turning first to look at kind of the overall broad picture of what's happening in the US economy. And I mentioned that the US economic growth has really been fairly resilient. I think there have been several times over the last several years where, forecasts have thought that growth was going to slow a bit more than it has. But overall, growth has held pretty strong. In 2025, real GDP increased 2.4%. So pretty healthy pace of growth. And if you look at those green diamonds on the right-hand side, you can see that the median forecasts coming from the FOMC are estimating that growth is going to come in at about 2.4% in 2026 and 2.3% in 2027. Of course, there's a lot of uncertainty behind these estimates, particularly with conflict in the Middle East. But overall, the outlook is for pretty healthy growth moving forward. Just a couple of other things to point out here on this chart. You can see that growth was quite a bit slower in the fourth quarter of last year, which is the latest number that's been released. I would say that's not overly concerning. A lot of that had to do with the government shutdown, and so we're expecting a bounce back in Q1 to kind of offset some of that slowdown there. We did see a little bit of a slowdown in consumer spending as well, but so far in 2026, consumer spending still looks like it's holding up pretty well. A couple of other positives for growth, the really drivers for growth over the last year and probably moving forward as well. I think you see a headline about AI investment probably every day on the front page of the newspapers. AI investment itself has been contributing quite a bit to overall real GDP growth in the economy. Another big factor I think to consider is healthcare spending. So we're seeing more and more jobs added in the healthcare sector. We're seeing more and more demand for healthcare services as the U.S. population ages, and that's been contributing quite a bit to growth as well. So, I mentioned some of the drivers for growth. The big one always for the U.S. economy is consumer spending. So consumer spending makes up about 70% of economic growth in the U.S., and it's been holding up pretty well. So you can see that overall consumer spending increased about 2.6% on average in 2025. As I mentioned, it was a little bit slower in the fourth quarter of last year, but the numbers seem pretty solid in January and February so far this year. A pretty sizable share of that consumer spending has increasingly been devoted to healthcare. So that is, I think, something to note. We've seen some shifts in consumer spending activity. And the other thing to really point out is that consumer spending has been pretty uneven across households. So on the right-hand side here, you can see that this is indexed back to 2020, but growth in spending among kind of the very high income and high income households has far outpaced growth in spending among other households. And so we do see kind of this unevenness to the US economy. A lot of people term it kind of a K-shaped economy, where kind of the upper income households in the US are really, really driving overall growth.
Allison, do you think that consumer spending will continue to go up with the rise in gas prices and other consumables?
Yeah, I mean, that's a great question. I do think, if gas prices remain elevated, I think there's a lot of uncertainty surrounding that. So I think a lot of that's going to depend on how long the conflict lasts, how long oil prices remain elevated. It does appear over the last week or two that with probably some structural damage to oil production in the Middle East, that those prices might remain elevated for longer. And so that could weigh on consumer spending a bit. I think overall in the US, energy consumption makes up about 3.5% of overall consumer spending. Of course, it varies a lot by household. So that would be things like gasoline, but also like electricity demand for homes. And so it's not a huge share of consumer spending, but as you move down to lower income households, it's going to take a bigger toll. And so I think particularly among lower income households, I think higher gas prices are definitely going to weigh on spending in that group.
Okay.
But great question. So I mean that transitions us nicely to kind of the overall inflation outlook. Coming from the Federal Reserve, we have a dual mandate, both to promote stable prices and also full employment. So I want to look first kind of at this price stability side of things. So this graph here shows two different measures of inflation. So headline inflation, so that's all goods and services, and also subtracting out those energy prices. Now, this is not going to incorporate quite yet the recent increase in gasoline prices. So keep that in mind as you're looking at that, especially at that headline number. Overall, this is CPI is up about 2.4% over the past year. So above the Federal Reserve's target. And I think one thing to note is that at the Federal Reserve, we look at all measures of inflation, but we really concentrate not on the CPI, which is probably the most common measure that you hear about, but more on the price index coming from personal consumption expenditures. And by that measure, inflation's closer to 2.8%. So really been running closer to 3% than our 2% target. And I think this is one of the reasons why you see the FOMC committee kind of holding rates steady this year, is that inflation remains elevated. And I think as the question pointed out, I think risks are skewed now to the upside as energy prices are kind of pushed higher for at least the near term and maybe a little bit longer term as well. Additionally, it does look like firm pricing behaviors may have changed post-pandemic. And so this is one of the things that we're looking at too. So here's two different measures. On the left, you can see the percent of firms reporting raising their average selling prices. That's sitting above 20%, and you could see a little bit higher than that was pre-pandemic. And then on the right, you can see firms reporting inflation as their single most important problem. And that's currently sitting about 12%, and it was hovering about 1 or 2% pre-pandemic. So, prices are on, I think, firms' minds. I think they're on consumers' minds. And I wanted to share a quote from Alan Greenspan, a former chair of the Federal Reserve, who defined price stability as inflation so low and stable over time that it does not materially enter into decisions of households and firms. And I don't think that's what we're seeing right now. I think that, inflation expectations have been fairly anchored, but I do think prices are on the minds of a lot of firms and households. And so, definitely a top priority for the committee is to bring inflation sustainably back to its 2% target.
Allison,
Yes.
will AI infrastructure needs impact energy cost and reduce consumer spending in other areas?
Yeah, so it's a great question. I mean, there's a lot of interest in AI right now. And right now, the primary impact that we're seeing is kind of the investment of building up AI, right? So the infrastructure surrounding AI and data centers. And as obviously everyone on the call knows, that requires a lot of energy. And so I think there are concerns about both energy costs and whether the energy infrastructure across the US can kind of support the quick growth. It does take a while to build up energy infrastructure. It's a lot slower to build that up than it is to build AI. So I think that is a concern. I think different states and localities are dealing with that in different ways. I think over time it could influence electricity rates for both businesses and consumers. But that's structured quite differently from state to state on who kind of bears that cost. And so similar to the higher gasoline prices, I mean, this would factor into that overall electricity cost. So again, I think I'm going to weigh a little bit more on lower income households. Certainly businesses could face higher costs as well, and they may or may not be able to pass those costs on to consumers. So that could either strain profit margins or kind of contribute to higher inflation overall in the economy. So I think it's a great question. I don't think we have the full answer yet, but I think it's another risk, I think, another upside risk, I think, to the inflation forecast.
Excellent. Thank
So,
you.
sure. So turning to kind of the last slide here that I have on inflation, firms also report that they're facing rising input costs, and that's shown from the manufacturer's point of view in kind of the purple here. It hasn't really surged over the last year, but it hasn't come down either. So most businesses are reporting that input costs are rising, and that's been across both labor costs, but also material costs have been rising as well. And in particular, you can see here, I've shown industrial metal prices have really surged over the past few months. And so this is all creating kind of pressures on businesses to think about how much of this can they pass on to consumers? We're hearing a wide range of some businesses can pass very little of this additional cost on consumers. Other businesses are able to pass along kind of the majority of the costs, but this is kind of both, I would say, straining profit margins and increasing the inflationary outlook. So turning now to the other side of the Federal Reserve's dual mandate, so looking at kind of the overall labor market. I've shown a couple of different measures here. On the left-hand side, you can see the unemployment rate. The unemployment rate has moved up marginally over the last couple of years. It currently sits at 4.4%. It's only up a couple of tenths over the past year. And 4.4% usually indicates a pretty stable labor market. Historically, that's a fairly low level of unemployment. Really looking at that measure alone wouldn't really indicate anything alarming. But what we have seen over the past year is a sharp decline in kind of the hiring rate or the number of job openings available in the economy, but also not a lot of layoffs. So a lot of people are terming this kind of a low hire, low fire environment. And so overall, the labor market looks to be fairly in balance. But for individuals that are looking for work, it has become increasingly difficult because the number of job openings has come down pretty significantly. There's just not a lot of hiring going on in the economy, but we also don't see this surge in layoffs. So it doesn't, again, doesn't look like we're anticipating kind of a sharp rise in the unemployment rate, but for certain individuals, whether that's those that have been laid off or whether it's new entrants into the labor force, it could be a challenging environment.
The price increases that you mentioned, do you think those are attributable to the tariffs that are going on?
I mean, so I think you could see some of it there. I mean, you do see goods inflation, which is primarily where tariffs would come in. Goods inflation has been somewhat elevated over the past year. So you see, I think, some effect of the tariffs, but I think it's broader than that. You see elevated services inflation as well. And services inflation can be impacted by a variety of things, but labor costs would be one of those. Usually labor is a pretty big component there. And so yeah, I mean, I think at the margin, I think tariffs are having an impact on inflation, but it's pretty broad. Earlier, housing had been a big contributor, although that has come down in recent months. But overall, services in general, that piece has been pretty elevated, and I'll point to healthcare as one of those pieces where we see some continued upside risks that it could move higher as demand for healthcare continues to increase, and that's one sector that really can't find enough workers.
You mentioned
So
the
a couple of
housing
the,
market, and
oh, go ahead.
you mentioned the housing market, and that's a topic that comes up actually quite often in terms of lots of corporations buying up properties to turn them into rental properties versus single family home ownership. What impact would that have?
Um, so I mean, so I think really the bigger question on the housing side is probably not the ownership of the housing, but just the overall supply of the housing. Um, so I mean, kind of the prices are going to be set at kind of a supply and demand. So there was just not enough supply of housing for quite some time, and we saw some I guess, dislocation of some sort during the pandemic where certain properties became more attractive, others became less attractive. And so I think there's been kind of some disruption in that market. But as supply increases, I think that's what's helping to pull down some of those costs, particularly on the multifamily side. We've seen a lot of units come onto the market, and that's kind of helping to stabilize rent prices.
Interesting.
But on the link,
Another question here, just real quick. Do you think that the final push of baby boomers leaving full-time jobs over the next 4 or 5 years will balance out the new jobs as automation continues to take jobs out?
um, So I think, I mean, so we're expecting a pretty large increase in the percent of individuals over the age of 75. So in fact, between 2020 and 2040, the share of individuals over 75 is expected to double to get to 12%. So we do expect retirements to increase. We're already seeing that, I think, in the labor market. It's one of the things kind of pushing down overall payroll employment growth. And so I do think you could see, as those retirements happen, uh, potentially that could allow more room for new entrants into the labor market, or you could potentially see productivity gains from AI kind of help to fill in some of that aging retirement gap. Um, Over time, I mean, I think if we see substantial productivity gains from AI, which I think is an unknown at this point, but if we do see that, I mean, over time, that would tend to boost, income gains and growth in the U.S. economy. Okay,
Interesting.
so
Thank
let
you.
me move on here to so I mentioned the unemployment rate's been fairly stable, but I think maybe the headlines are really dominated by the fact that payroll growth has slowed pretty substantially. So looking at the blue bar there, you can see that the U.S. economy only added about 116,000 jobs in 2025. So pretty low number of jobs added. Um, about 10,000 jobs per month. And you compare that to 2024, where we're adding about 121,000 jobs per month. So just looking at that on the surface, I think can sound a little bit alarming, a pretty sharp slowdown in payroll employment growth. But a lot of that I think can be attributed to a couple of factors that relate to the overall growth of the labor force. One of those is immigration. We've seen a very sharp decline in immigration. which is putting a lot of downward pressure on how quickly the labor force is growing. The other piece was just mentioned is the aging demographic of the U.S. economy. So increased retirements are also putting downward pressure on kind of labor force participation rates and the number of people in the market. So most economists think that the kind of the break-even payroll employment growth has dropped pretty dramatically just over the past year. And so this number is not quite as alarming as it looks, and that's the reason why the unemployment rate hasn't really surged, even though payroll employment growth has come down quite a bit. The other thing I wanted to point out here on this chart is in the purple bar there, the number of jobs added in the healthcare sector was about 686,000 in 2025. And so you can automatically see that really gains in healthcare employment have dominated overall job growth. In fact, without those gains, the economy would have lost jobs last year. So I think it's something, to keep in mind that, again, we're seeing pretty stable labor market conditions, but those gains have been uneven and really concentrated heavily in that healthcare sector. So moving to the next slide, kind of the last one here on the labor market. These are two different indicators that we put out at the Kansas City Fed. These are labor market conditions indicators. They're comprised of 24 different labor market variables. So they take into account things like the unemployment rate, but also take into account things like job openings, the hires rate, how many jobs are we adding? So really a broad measure of labor market activity. And we think this is a good way to kind of monitor overall activity and the momentum in the labor market instead of concentrating on any one indicator. So here, anything below that zero mark indicates that activity or momentum is below its historical average, and anything above means it's above its kind of long run average. And so here you can see in the blue line first, kind of the overall level of activity. You can see activity has been slowing over the last few years. So there was kind of the surge in hiring labor market activity following the pandemic. That level of activity has come down, but it does still remain above its long run average. So overall activity is at a pretty healthy place, but certainly has slowed. That momentum indicator in purple there, you can see it dropped below that zero mark for much of 2025, indicating that kind of the momentum in the labor market was slowing. And so that's reflective of a lot of those trends that I have been talking about. So the slowdown in hiring, the slowdown in jobs, slowdown in employment growth. You can see that there, but just recently over the last couple of months has moved back to its long run average. So it does look like the labor market has slowed, but now it's fairly stable. And so I think that's a good indicator for conditions in 2026. But overall, when you're thinking about the Fed's dual mandate of price stability and full employment, they're really facing risks on both sides of that mandate. So you can look at that in a variety of ways, but I have shown some probabilities derived from the survey of professional forecasters. On the left-hand side, you can see the probability of inflation above 3% next year. And you can see that's sitting a little below 20%. It has come down a little bit, but so you can see that there's a large number of forecasters expecting inflation to remain above the Federal Reserve's 2% target. And then on the right-hand side, you see the probability of unemployment above 6%. And again, you see a significant number of forecasters expecting unemployment rates to rise. And so this puts the Federal Reserve, I think, in a little bit of a tricky situation where inflation is too high, and there's also some risks on the labor market side as well. So what has the Federal Reserve done overall? So last year, towards the end of second half of 2025, the Federal Reserve lowered the federal funds rate by 75 basis points. And I think that really happened as inflation was moderating a bit. It was still above the Fed's 2% target, but it was trending down. But you also saw labor market softening. And I think that there was a time where the risks on the labor market side appeared to have increased. So there was some concern that labor market activity was going to potentially slow at a faster rate. And so you saw the Federal Reserve start cutting the overall Fed funds rate. So far this year, the Federal Reserve has held the federal funds rate steady. I think that indicates a couple of things. One, it seems that the labor market has stabilized, and inflation remains closer to 3% than its 2% target. And I think there's some upside risks on the inflation side, and particularly recently, I think the conflict in the Middle East certainly indicates some upward pressure on energy prices that could eventually get passed through other channels as well. But looking at those purple dots, those are forecast, the median forecast from FOMC participants for the federal funds rate at the end of 2026 and the end of 2027. And the median forecast suggests potentially a 25 basis point cut this year and another one next year. But I will say there's a lot of uncertainty, right, to this forecast because the Federal Reserve always reacts to the incoming data. So we'll continue to carefully monitor labor market conditions and inflation conditions. So another thing that I wanted to just kind of close out with is that, one of the things to keep in mind when looking at the overall federal funds rate is where does it sit compared to where we expect it to be in the longer run. So if the economy was exactly where we wanted it to be, so it wasn't accommodative, if we weren't restrictive, where would that federal funds rate be? And that currently in the most recent projections is about 3.1%. But what I wanted to show, and so you can see that the current rate in blue is a little bit above that 3.1%. So indicating that policy could be slightly restrictive, but it's not really it's not substantially restrictive. You can see, in fact, that the blue line is within kind of that gray shaded area, indicating that for some participants on the FOMC, the current policy may not be restrictive at all. And one thing I wanted to highlight here is the movement in that black line. So where the committee expects at the median, kind of the federal funds rate to be in the longer term. And you can see that back in 2016, that rate was about 3.5%. And it moved down to about 2.5% in the early 2020s. And I think really that was indicative of kind of a long period of pretty moderate growth in the U.S. economy, not a lot of inflation in that time period. And it looked like we were just going to grow at a slower pace. And I think that a lot of that was reflective of the aging demographic. So we knew that the baby boomers were going to start to retire. As they retired, the labor force is going to grow more slowly. And as the labor force grows more slowly, that kind of puts downward pressure on how quickly the U.S. economy grows. But you can see here more recently that's moved up. And I think there are a few things that could be pushing that up. And so I wanted to highlight just a couple. One is that productivity growth has exceeded its recent trend over the past year. So it looks like productivity is picking up. And I think that could be for a variety of reasons. A lot of people point to AI. And I think that we do see potentially some gains there. But I think there are a lot of unknowns just in terms of how productive, how much that's going to increase productivity. A lot of people are optimistic, and I'm hopeful there. But I think another contributing factor is that the quits rate has come down. So when labor markets were particularly tight in 2021, 2022, we saw a lot of turnover in the labor market, and a lot of turnover leads to a lot more training that's necessary, and it leads to kind of lower productivity in general. And so as the quits rate has come down, productivity has moved up. And again, AI could be helping there as well, or automation in general, not just AI, but could be boosting productivity. And I think if that continues, that's likely to boost the overall long run growth for the U.S. economy, which tends to push up interest rates in the longer run. Here's just quickly kind of current and future AI use. So this shows like what they reported in 2023, but then again, what was reported earlier this year. We do see uses of AI increasing pretty dramatically. Again, I think there's still a lot of unknowns in terms of kind of how much productivity gain can we get to this increased usage. I think there are a wide number of estimates, but this is something that we're watching carefully. I think everyone's watching carefully to see just how much this can boost growth. Right now in the U.S. economy, it's mostly boosting growth through investment. So not necessarily from productivity gains, but from the sheer investment in the AI sector. Another a factor that could push up interest rates in the longer run is the supply of government debt. So these are projections from the Congressional Budget Office. This is debt held by the public. So you can see that this has been rising as a share of GDP and projected to continue to rise on the horizon. And so as the U.S. issues more debt, that tends to drive up longer term interest rates. And then the last factor that I'll point out, this is that's actually weighing on longer term growth and would push down long term interest rates is the aging population, and in general, I guess just a slowing population. So this shows projections again from the Congressional Budget Office, but you can see some slowdown or sharp slowdown, I guess, in 2025 in terms of net immigration. So I think that's reflected in particularly in those payroll employment growth numbers. But also as the population ages, eventually we're going to see a natural decline in the population. And so that will overall weigh on growth, particularly through kind of the limit on how quickly the labor force will grow. So I'm going to stop there. I would say overall, I mean, the U.S. economy has been remarkably resilient. Growth continues to be fairly solid, but I do think that uncertainty remains elevated. It has been elevated for quite some time. I'd say maybe increasingly so over the past month or so. And certainly there's some upside risks to inflation. I think I'm about at time. If there's, one additional question, happy to take that.
Excellent. If you'll get these final slides over to Ryan or anybody on the team, that would be great. I'm sure that attendees want to click on that, subscribe to the Federal Reserve email alerts. I know that I do. So thank you, Allison. Great
Great.
information.
Thanks
Allison,
so much.
thanks for your
Yes.
time. Appreciate it.
Yes, thank you very much.
Awesome. Good stuff. Okay, I know that was quick, a lot of information, but all super important for our industry to recognize not only from inflation growth, but from labor trends and automation trends. Ken, I'm going to ask if the rest of our committee will come on board and start a discussion on those topics.
Yeah, well, I can speak firsthand that automation is really affecting our business, especially with the new equipment that's coming out there. We've been looking at machinery that employs robotics, and a lot of it with the computers. There's so much technology out there, and the machines are getting smarter, and it's reducing the need for some operators, but I don't know if everybody else in the group is seeing a lot of that. But going forward, I fully expect that most printing companies are going to need automation to stay relevant as people start retiring. I feel it could be the brain drain once our older operators start retiring. We got to figure out a way to transfer that knowledge. And I think a lot of the automation is going to do that.
Hey, Ken, how are your employees reacting to the automation piece of that? Do they have any fear built in with that? How are you guys handling that?
I find, Ryan, that the older people don't embrace it as much as the younger people. And I think that's just part of fearing change. Whereas, if I look at my kids, they're not afraid to look at something and try to figure it out. Whereas some people that are a little bit older will put their hands up and say, no, that's not the way I do it or the way I've done it. So if you got to figure out a way to have people embrace that change.
And one of the things we've done internally here, at least regarding AI, right, is just have our IT folks just give some training and some background about what is AI to our employees. So it's not something that's, it's just a term. It's like actually understanding what does it mean? How does it work? Where does it come from? How can you use it? Just to get people more comfortable with it and not be afraid of it, I guess, and to look for ways that they can embrace it and how they can utilize it in their roles to make their life easier.
Certainly as a tool and not a position eliminator.
Right.
In fact, I mean, we've been dealing with a workforce crisis for a number of years now. We do not have enough workers to support our industry going into the future. So we need automation. We're going to need some AI to take the pressure off some of our workers so they're not overworked to relieve some of that strain.
Definitely agree.
Yep.
Other thoughts on the presentation that she made? It seemed very or came across as though the economy is more stable than sometimes it feels out here in the middle.
The inflation part just gets me. I feel like there's more inflation out there than what her statistics say. It just, you go to the grocery store, you go to, a department store, anywhere, even online, you see the prices and you go, "Ooh, that's not what I paid for it the last time I bought it." And you're seeing a lot of price pressures. And it feels like, at least in the printing industry, we're trying to present price increases, but the competition's keeping the numbers down, and it makes it harder.
Yeah, right.
Everyone
It's
else.
still hard to pass along increases. And I think we recently got some letters from some vendors about pricing pressures and to expect some increases coming soon. It's like, all right, then we got to prep our customers to try to pass along some of those too. And it's a process for sure.
Definitely.
Do you guys feel there is some of this that's knee-jerk reaction, and the increases are happening just out of fear?
I think some are. I think a lot of it too, like with the unrest in the Mideast and the prices with the fuel. Well, the fuel, filters down into freight, and moving our consumables in, it's going to bring the price up on everything. And so I think a lot of people fear that, right out of the gate, and the uncertainty on the time frame of it. Is this going to be a long, dragged out war, or is it going to be something short that they can figure out a way to finish it and, end it so that people can try to get back to quote unquote normal without the fear of, all of these issues outside our borders.
Yeah, it could be to some degree. There's don't let a good opportunity go to waste, right? There's an opportunity, there's fear in the market. You can use that as an excuse. Maybe you had some slow increases and now you can use that as some turbulence in the market, and that's a good excuse to go ahead and push through some increases.
Yeah, but the question is, are they going to be sustainable, or are they going to just be something right now that 2 weeks from now it might escalate even further, and it spirals.
Right.
Yeah, it's uncertain times, that's for sure.
This is a great discussion. I'm going to ask if those that are attendees want to join in the discussion. Feel free to unmute yourself, turn your video on, or type in the Q&A or the chat field to contribute to the discussion. Certainly, we have a comment here that says they feel like the direct customers in design and production will be disrupted or be displaced by AI, and they're continuing to more of a true marketing partnership with CMOs, CFOs, and procurement. What are your thoughts there, gentlemen?
I think that's a pretty accurate statement. You see some of these larger marketing firms, if they get someone that's really good at AI, they can, eliminate a lot of positions. Or if, someone is savvy enough on the print side and they hire these people away, then they can build up their own marketing department and sell those services as additional value-added service to the customer. So yeah, it's uneasy, and the people that embrace the technology change and figure it out fast enough are the ones that are going to benefit from it.
Mm-hmm.
So yeah, Bob's point is very well taken.
I think we see it happening certainly on the design side, that the technology of AI and the computers are moving faster and will definitely influence the marketing side. He also mentions CFOs and procurement. What are your thoughts there?
Well, if they can figure out an AI way to buy things better, less expensive, but maintain the cost, there's a bigger profit margin. So yeah, it's a very good point.
Yeah, if there's a way to analyze, what you're purchasing and purchasing patterns and try to make it the most efficient and group things and buy things at certain volumes that maybe you aren't seeing by yourself. That's the kind of thing that the efficiencies hopefully that it can add without, so you still have someone, a person there to kind of direct and take that input and place the orders and manage it, but it helps point out things that you maybe aren't seeing with all the data that's out there for you.
Do you think it will put the printing industry potentially at a disadvantage in some areas because our industry has always been such a great opportunity for entrepreneurship? So it is a lot of smaller to mid-sized companies. We have seen mergers and acquisitions and bigger companies getting bigger. What are your thoughts there?
I think the ability of the new machinery, I think you still can have a spot for an entrepreneur if they have like a niche business. I can see the bigger companies getting bigger, but if you have a small firm that has, the knowledge in a certain segment of the industry, I think there are spots where people can jump in and take advantage of the market.
Yeah, that's true. If you can find a niche or if you can find a need of some subset of customers and you can deliver that better than what's currently out in the marketplace, there'll still be a place for you.
Yeah. Ken, I think you mentioned earlier that our next presentation is actually going to be on mergers and acquisitions. That's coming up on May 20th. So for those attendees that are with us, we want you to mark your calendars, but we also want to open a discussion to other important topics that should be added to the agenda for future programs. If the group has suggestions, we would love to hear them.
Yeah. And then to tail in on that M&A stuff, if someone's had experience with that, if they'd like to share some of their pain points, we can research that and make that a topic, a subtopic within the presentation. Because the way we're planning it right now is we'll have LB Carlson lead the discussion and they work in that realm. But if there's a pain point that you've endured or encountered, we'd love to hear about it so that we can address it and then maybe, throw out some best practices.
That's a great point.
Mhm.
Certainly, we have seen some of our entrepreneurs in this industry look and take advantage of opportunities to diversify and get into other segments of the business that they didn't traditionally offer. Do you guys see that happening on your end as well? Are you guys doing that?
I think it's both maybe expanding or also just finding tuck-in opportunities, right? Find additional business you can bring into your own four walls, just kind of fill up capacity.
Are your companies looking at diversifying? How is the capital expenditure needs changing with equipment and AI and automation? Are those things getting substantially more expensive as compared to the past? I mean, presses have always been expensive, but into
We've been looking to upgrade some of our equipment, along the same lines, just get newer technology to hopefully improve the processes. But right now, it's up to our sales guys to open up new doors. And then we look at, can we fit that on what the equipment we have now? Or if not, what's the impact of getting a new machine that, we've got to find someone to operate it, train them, and then enter that market. At what costs, you got to find the cost benefit to it.
Right. There's certainly, especially if you're looking at new equipment, it's always you want the latest and greatest and the digital aspects of it, right? Because that seems where a lot of the growth and opportunities are, so you want to make sure that you're still at least in the leading edge of the curve in sort of digital technology.
It seems really obvious on the software side. I mean, the advancements are coming faster and faster. Certainly, even on the press side, I don't see it as much on the binding, finishing, mailing side. What are your thoughts there? Do you think it's coming? Do you think they're going to catch up?
Oh, we're seeing some of that. We've got a new folder gluer in here, and it's a neat piece of equipment. So they're out there. The bindery is making advances. So yeah, there's technology out there.
Excellent. What about the mailing side?
That one I haven't had as much experience on.
Yeah, me either.
Any thoughts from you, Ryan? You guys do handle some mailing.
Yeah, yeah, I would say that there's definitely faster technology out there. But I think a lot of times it comes down to the capital expenditure and the cost benefit analysis that you do on it. It's definitely out there, but it gets more and more difficult to justify the expenditures that are there.
Where do you guys see that going on the mail side? There's some things happening right now with Congress and our federal government related to mailing that are going to impact our industry a great deal. And so just two items. The SEC did pass the House to move financial documents to a default of electronic delivery, where it was mail delivery and you could opt in for electronic. That was proposed to switch. Our goal is to try and block that in the Senate. However, that would be a huge displacement in our industry. And then the second thing is, of course, Amazon's agreement with the Postal Service and moving that. The contract is up in October of this year, which will impact pricing on postage as well. What are your thoughts?
Definitely, and the impending price increase. Because budgets have been set if you're on a calendar year basis. And when that budget increase comes, or when the price increase comes through, I believe is it July? I'm not 100% sure, but when that thing comes through,
Yeah.
that's going to disrupt everybody's budget.
Not only that, Ken, but there have been rumors for the last two price increases. Well, the January didn't happen, but last July there was discussion and fear in the mailing side that they are going to move the non-competitive, meaning letters and flats, to zone pricing, just like their packages. Well, if they do that, postage is no longer postage. So if I mail letters from Kansas City to Chicago, my price is one, but if I mail it to California, it's another. We're seeing that our customers will likely split their projects and move it to shops in the three different zones, West Coast, Central, East Coast, to get the better postage. And yes, in the long run, it should balance out, but it would be a huge impact to mailers right off the bat.
Yeah, that would be disruption, an extreme disruption in the market. Bob says, in his opinion, many manufacturers in our industry focus on savings on the press room, bindery, and mailing, while he thinks there's more savings on sales automation, job input, online input, accounting automation, and billing and accounts payable. Would you agree?
Strongly.
Right.
The less touches, the better.
Yep.
Yeah, certainly maybe on the software side, there's opportunity that's happening a lot faster and quicker than potentially on the production floor.
Well, I know just our experience, we're emailing now about 99% of our invoices, where in the past we were mailing them. And so that's a cost savings right off the bat. But yeah, automating, like I said earlier, the less touches, the better. That frees up other people, that are touching these jobs to do other things within the business. If we spend hours to do invoicing and collections and stuff, So if you can automate that, you're saving money.
Right. Good point. If we go back to the conversation about Amazon and that work going somewhere else and the Postal Service not having it, there has been some controversy on that may be good and the Postal Service may be more efficient because that last leg of delivering those packages is the hardest part. Yet it still will leave a huge deficit in the Postal Service's budget if that business goes elsewhere. And how do they make up for that besides increasing prices? What are your thoughts?
I think if that piece goes away, I think it's going to take time to see what impact it has. But the Postal Service's 10-year Delivering for America plan and switching from they've already closed NDCs to now moving to RPDC so that they can collect, letters, flats, and packages all in one area. If that piece goes away, does it even make sense to move forward with the RPDCs?
Yeah, that would change a great deal. So there are some unknowns. Everything I'm reading says it appears that Amazon's going to move 2/3 of their current workload that's with the Postal Service away from where it is today. But we'll wait and see what else predictions. Do you have more insight?
Well, I think the other piece of this that I've been hearing, and it's probably just rumor mill, but with the post office just continually losing money every single quarter, are they forcing them into a privatization?
But if they lose that business, someone's got to pick it up. And if they can do it more efficient, maybe like you said, Ryan, the Postal Service morphs into something different and some privatization of it, fills that void. Someone that can do it faster, more efficient, is more nimble.
Yeah, I think the question is, can Amazon eventually figure out how to make the package delivery entirely inside their network and just pull out completely of the Postal Service? And they can do it. If they can do it better, faster, cheaper, they will lose. Yeah, the Postal Service will lose that business.
The privatization comment is a great discussion point where some are in favor and some are not. From a society standpoint, the downside is if it's private, they don't have to serve all individuals or all communities, and certainly rural communities would be at a disadvantage versus metropolitan areas. From a government perspective, they have to serve all American citizens, but from a private perspective, they don't. Do you think that'll impact our industry?
It could, but there's entrepreneurs out there that could figure out a way to get it out to the rural outposts, so to speak, and maybe they can part out, so to speak, small town post offices, and they figure out a way to push it out to a centralization or a central location, and then an entrepreneur takes it and moves it out to these rural locations. The fee might be a little bit higher, but they can still use the network that the USPS has and figure out a way to do it a little bit less expensive.
Mm-hmm.
And I think we've talked about it for years, but does it even make sense for the Postal Service to be delivering 6 days a week? Is it necessary? Would it help them to back off and maybe deliver 5 days a week, especially in rural areas? Maybe you're down to 4 days a week, and maybe you're just delivering to businesses Monday through Friday.
Good point.
Yeah.
Very good point. All right, gentlemen. Other topics of discussion you would like to cover?
At this point, I just want to say it seems like we're not getting a lot of input from people for future topics. If something comes to mind, please run it back through the PIM or the PIA Midwest and just get it out to your representatives and throw it our way, because we discuss, we have a planning year annually, or planning meeting annually for what we're going to address throughout the year, and we can incorporate these topics. So everybody's feedback sure would mean a lot. So if you don't feel comfortable in this forum, please come and get us, outside of this forum so that we can address what everybody be interested in.
I think the mergers and acquisition webinar that's coming up next will be very insightful. I'm looking forward to that.
Me too. There's a lot of activity happening there. Carl, any last comments from your side?
Not for me. Thanks everyone for participating.
Yes.
And thank you to this committee that drives the conversation, the education, the knowledge sharing. It is always bringing new and exciting topics that we need to be thinking about how our future is going to change. So thank you to the three of you and the rest of the co-chairs. We appreciate you. We will end the call today. We want to encourage the conversation to continue. If you do have comments, questions, or thoughts on future programming, as Ken said, please get that to us and we'll try and incorporate it into the programming. Thank you all and have a wonderful afternoon.
Take care. Bye.
Thanks, everybody.
Bye-bye.